Very honored to have Leon Black here, as you've heard, the CEO and chairman and founder of Apollo, a firm that I think everybody here is probably fairly familiar with. Leon, thanks for doing this. Now, Leon, a few years ago at a conference, you famously said you were going to sell everything that wasn't nailed down. Now, as it turns out, the market still went up, so was it premature to say it was a good idea to sell, and did you sell everything that wasn't nailed down?
Okay. Sounds like a trick question to me. First of all, it's great to be back at SuperReturn. This is, I think, year number 11 for me. The first one with actually good weather in Berlin, and it's great to be up here with a titan of our industry. It seems a little unfair, though. You seem to have the upper hand. One, you're a television celebrity, and two, you get to ask all the questions.
Wow.
I thought of ways that we could counter that. If you've ever been to a psychiatrist and you ask them a question, what do they think about something? Right. They always come back and say, well, what do you think about it? So I thought maybe I could do the same.
All right. I've never been to a psychiatrist, though. Nothing wrong with psychiatry.
Or we could go the route of, you asking about the Scream, I ask you about the Magna Carta.
Okay. Well,
well,
the Scream costs a lot more than Magna Carta, but.
But I thought since the chips fell this way, I would go with the setup that has been arranged with you asking all the questions. But I do reserve the right to switch over to the other pathways. Now, to answer your question,
you want your own TV show, in other words, you're auditioning for
one day.
Okay.
So I'm sitting at your feet and watching and learning.
Okay.
Selling everything that's not nailed down. Now, you have to agree that was a catchy phrase. So we got
a lot of attention.
We got a lot of attention for that. I think with 2020 hindsight, my guess is we could have gotten more by waiting. I'm reminded of the famous phrase by one of the Rothschilds, I forgot which one, who said, well, how did you amass this fortune? And he said, actually, I amassed the fortune by selling early. And our view has always been to take chips off the table, de-risk our portfolios. We make money in private equity on the buy, also on building value, and then finally on the sell. I think
so no regrets. Subsequent to that, you did go out and raise the largest private equity fund ever. I think it was $25 or more billion, right?
Yes.
So on that fund, what are you investing in now? What areas are you most pleased to look at? Are there certain sectors or certain parts of the economy? And is it mostly in Europe and the United States you're investing this money?
Okay. Again, multiple questions.
You can pick and choose.
Look, our whole MO, our strategy, has been to try, and this is throughout our 29-year history, is to put money to work, no matter what the environment is, into good companies on a attractive risk-adjusted return basis. And what we've tried to do is develop multiple pathways, if you will, to be able to do that in differing environments. So those pathways have included distressed investing. Two funds ago, over 2/3 of that fund went into distressed. Our last fund was less than 5% distressed. We go into complex deals, carve-outs, build-ups. We go into idiosyncratic buyouts in about 9 different industry areas. Most of our investing, probably 80%, has been U.S. Directed. About 15 to 20 has been in Western Europe, and about 5% other. And that's pretty much been constant and what we continue to do. As to areas of specific attraction, today I think financial services has been something we've done a lot. But having said that, we're opportunistic across those 9 or 10 industries.
So you started your firm in 1990. I think.
Yes.
And in the early days of private equity, and that was relatively early, 1990, early 90s, the rates of return that people expected from very good investors like you was probably higher than today. Would you agree that it's harder to get the returns that you got 10, 15, 20 years ago? And what kind of returns are you trying to get in your main fund for your investors today?
Well, I think we may be a little bit an outlier in two respects. One, our whole DNA has been focused on value investing. So through those different pathways I described, we try to buy good companies at low multiples, and that is what we've done. Our last two funds were invested at about a 6 multiple of EBITDA when most of our peers were at 10 or 11 times. That has worked for us, and frankly, our return criteria have not changed over the last 29 years. Our feeling has been if an investor is locking up their money for 10 years, and so they have a basically illiquid investment that's levered, that they deserve a return with a 2 in front of it. We still underwrite to a low 20s return. Over the last 29 years, we've been fortunate in being able to generate a 39% gross, 26% net. Now, we don't do that every single fund. That's an average over 29 years. Our worst has been about a 10% net. Our best has been about a 45% net. But the underwriting criteria is always to be in the low 20s.
So in the last Great Recession, you were famous in your firm for buying a lot of distressed debt. Some of it was your own deals, some of it was other people's deals. Was that an inspiration that you had? Let's go buy the debt at a discount. And were you worried at any time that buying this debt at a discount might lead to not very good returns? Or did you have a pretty good sense these were going to be spectacular deals ultimately?
Well, you have to remember that I came from, and my founding partners, Mark Rowan, Josh Harris, and many other people at Apollo, from Drexel Burnham originally, which was the Mike Milken School of Studying Capital Structures. So we were all about understanding capital structures. I was the head of M&A and then investment banking at Drexel. So the whole leverage buyout industry, about 75% of it were our clients. So we saw the use of debt on the successful deals, and we saw the restructurings that went on the unsuccessful deals. And you have to also remember that we started Apollo really in the ashes of Drexel's demise. About 4 months after Drexel went under is when we started Apollo. And we did it with the help of a large French bank, Credit Lyonnais. And we were doing it, there was a big recession then. There was, the global economy was down. You had oil shocks. You had consumer pessimism. Frankly, we were doing a lot of distressed debt purchases when we first started, and then we bought the executive life portfolio, which was 400 positions, 6 billion face. We bought for 50 cents on the dollar. So we were managing a high yield portfolio. So debt and credit and distressed has kind of always been part of what Apollo's been about. Now, you have to make sure you're disciplined and that you're looking at the debt of good companies with bad balance sheets and not so much turnarounds, but really companies that are over-levered and buying distressed debt and going through a restructuring is a buyout in reverse. It's delevering the company to its appropriate capital structure. So that is something we've now been through 4 recessions over the last 29 years, and turning on that distressed dial has been a very good source of returns for us.
So a lot of people are obsessed with STEM education because they think if you want to make it in today's technology-driven world or in the finance world, you need to have some kind of engineering or math background or science background. At Dartmouth, where you went to college, you majored in history and philosophy.
That's correct.
And you graduated summa cum laude, so how come you didn't become a philosopher or historian? Did you ever think of that?
What makes you think I'm not a philosopher?
Well, maybe you are. Philosopher king.
Okay.
So when you graduated from Dartmouth, did you know what you wanted to do? Did you know you wanted to, you did go to Harvard Business School, but did you know when you were at Dartmouth that you wanted to go into the investment world, or you didn't really know that then?
I didn't know it. I thought probably I actually would be an academic and teach. My father convinced me to go to business school just to get the exposure and then to do whatever I wanted. I hated business school, frankly. And then he died while I was at business school, and then I wasn't sure what I wanted to do. I bounced around in management consulting and publishing. At one point, I thought I'd go into film. And
As
then,
an actor, producer?
I think acting would have been a stretch, but
Okay, producer.
I think I then met Fred Joseph at Drexel, and then met Mike Milken, and was very attracted to what they were doing.
So you ultimately became the head of M&A at Drexel, and then subsequently Drexel went out of business, imploded. When that happened, did you think your professional career was over? Did you know what you wanted to do? Did you think of starting your own firm? Or how did it come about that you decided to relocate, I guess, and do this?
Well, sometimes being lucky is more important than anything else, I guess, as long as you know what to do with the luck. As I mentioned, I had been very involved with most of the players in the private equity industry. We were bankers to KKR, to Odyssey, to Tom Lee, to a lot of the then major players. So it had always been in the back of my mind to try to create something small. Now, Drexel was a rocket ship that went up for 12 of the 13 years I was there, and then it crashed and burned. I got just a total cold call from somebody at Credit Lyonnais I'd never met. We had never dealt with each other. Would I come and run their M&A, to build it and run it for them? And I said, what M&A? This was the spring of '90. There was no M&A. The financial markets were shut. The country was in recession. I said, why don't you become an anchor financial partner? And there are a lot of undervalued situations out there. We can make a lot of money together. So I spent most of that spring kind of in a shuttle diplomacy to Paris, which wasn't a bad thing, for about 3-4 months. And the upshot of that in June of '90 was that we opened our doors. They invested $800 million. $400 was a managed account for them, and $400 was the first Apollo fund, and they were mirror funds.
And where'd you get the name Apollo?
I've always loved Greek mythology, and Apollo is not only the god of light and reason, but he was the god of healing. And given the Drexel debacle, I thought that was an appropriate name.
Okay. So today, as you look back on 29 years of investing, what would you say are the deals you're most proud of having done?
Well, one of them I mentioned, highly complex deal, was Executive Life. I think that really put us on the map in '91. It was a complicated deal. It was an insurance company that had been in rehabilitation by the insurance commissioner in California. There was politics involved. The Federal Reserve was involved. The banking committees were involved. There was a foreign bank, Credit Lyonnais, involved. And it was a very, very complex portfolio. We were interested in it because you had so many potential restructurings that were, large positions in companies of debt, which might be converted into ownership. you also had a lot of, quote, good junk, and then you had a lot of real garbage there. So to be able to manage that, of course, all that analysis didn't matter because life happens and the market spiked and we came out of a recovery and everything we analyzed didn't work, but it all went up, so that was very good. And so I'd say that was one. I'd say Lyondell Bazell.
Now, that's a deal where you bought
recent.
the debt. That's like a $9 billion profit or something like that?
Something like that. And that was a classic restructuring. It was a company, one of the largest chemical companies in the world, and it had about a $5 or $6 billion EBITDA in a normal economy, and they had about $25 billion of debt. And then the recession came in '08, and it was deep. And all of a sudden, their EBITDA went to $1.5 billion, and they couldn't service all the debt. And so we bought a lot of the senior debt. We became the largest holder of senior debt. We also put in a dip line. And we went through a bankruptcy there. And as I said before, restructuring is about delevering. We and other creditors decided what was the appropriate capital structure, which we decided should be $5 or $6 billion of debt. And we just got it through and approved by the judge. And then we came again, like Executive Life, came into the recovery, and it went back to $6 billion of EBITDA, now with only $5 billion of debt. We made a lot of money.
So some of your peers have built out large businesses in Asia. You have not done that. Is there a reason, and the emerging markets, is there a reason you haven't done that, or is there something you're going to do in the future?
Well, your question is half correct.
Okay.
We have spent about 10 years in India. We're partners with the large bank there, ICICI, and we have a fund with them, a 50-50 fund. So we've had about 25 people in Mumbai. We have offices in Hong Kong. We have offices in Singapore. We have offices now, as of last year, in Tokyo. But the correct part is that we really haven't done a lot. You know, we've done a little bit in credit, we've done a little bit in real estate, but very little in private equity. And frankly, it's because we haven't figured out a way to be, quote, smart money. There's a lot of money over there. Prices are extremely high. In China, it's very hard to do a control deal.
I'd say there's a lot of competition there. Probably you don't want to go to Asia. There's too much competition. So I would say you're doing very well elsewhere. But let me ask you, one of the best things that Apollo has done ever, I think people would say, is something relating to your permanent capital and Athene. Now, Athene is an insurance company that you are very involved with managing money for Athene. It's worked out extremely well. How did that idea come about?
It came about through my partner, Mark Rowan, who is incredibly capable, and about 10 years ago felt that there was an opportunity given where spreads were. It's a life annuity spread business on the reinsurance side. And so we started there, and we put a bit of capital in and raised some other capital from third parties. And over the last 10 years have grown it into a very significant factor in the life reinsurance annuity business. Now have a public company that's out at about $11 billion valuation. It manages about $115 billion of assets. It's a great platform also for having built up our credit business, because it has an unending appetite for different credit products, spread products. You know, in life you can lever 12, 13 times as opposed to P&C, which is more like 3 times. So if you can build in manage your money and build in a 1 and 1.5% spread vis-a-vis your cost of borrowing, you can, lever that and get a 15 to 20% return. And, since then, we've now built up another platform in Europe called Athora. God knows where we get these names. But it is meant to be another Athene. Right now, it's about 15 billion euros.
Everything has to
of
begin with
assets.
A, right?
Always A, yes.
But let me ask you.
And the last thing I'd say is that the balance sheet on Athora will allow us to get to about 50 billion, given the capital that's in place.
So you took your company public, as some of your peers did. Any regrets about taking it public? And why do you think that the entire world doesn't properly value private equity firms that are publicly traded?
Now, that's a softball if I ever saw one, and one which I'm going to put back to you also. But it's one I scratch my head on. Look, when we went public, I talked to about a dozen smart people who were friends and said, what do you think? And half of them said, you got to be crazy not to go public. This is a way to monetize your ownership. It's a way to build a brand. It's a way to keep your best employees. You'll have consideration to expand from an M&A point of view. And the other half said, what are you, crazy? You're going to put yourself into a fishbowl, regulation, press, who needs it? And I think we were 60-40 tilted towards doing it. And they were all correct. The fact of the matter is we like to say that we have built a unique platform which encompasses value, encompasses growth, and encompasses yield. And the market doesn't get it. I was lucky enough to build up personal wealth through the carry before we went public. We went public and the market said, we don't value the carry, it's too unpredictable. Even though we were a firm that's sitting with 90% permanent capital or 10-year, and we have the track record I mentioned in private equity, we still get almost no valuation. So they said, you really need to just focus on your FRE, which is the management fee. So in the last 5-6 years, we have grown our management fee from 50 cents to about $2 a share, which has been like a 22% rate of growth. And on top of that, there's a 7 or 8% yield on the stock. That's why I say it's yield, it's growth, and it's value investing. And there's a disconnect with the market. You've experienced it.
Right.
I've experienced it. Everybody in our industry has.
So if somebody said today, I want to, despite all these challenges in the private equity world, I want to build my own Apollo, would you think today it's possible for a young professional who was at the age you were when you started, or how old were you when you started? You were in your 30s?
38.
38 when you started. So do you think today a 38-year-old could build an Apollo or an equivalent today, or is it too hard today to do that?
I think there are always opportunities. I would never say never. And I think especially, America still is a land of opportunity, and I truly believe that.
Okay. And because of the wealth you mentioned that you've been fortunate to get, you have been able to buy something in your passion area of art. You famously bought something called The Scream.
Remember Magna Carta?
Well, it's a fraction of the cost, but so on The Scream, what is he screaming about? Is it the
Probably about the carry.
carry changing the carry taxation, right? But so where did your passion for art come from? As a youth, did you have it, and this something that you spend a lot of your time on in your free time now?
My mother was an artist. I used to go and review all her work, and we'd decide what was good, what should get framed, what should be thrown out. My aunt was a very good art dealer. My uncle was an artist, so I had no escape. I grew up with it, so it's always been a passion. It's my wife says it's a sickness. I think it's a magnificent obsession.
And your collection is in 3 different areas?
I collect I love works on paper, really from the Renaissance to modern times, paintings and sculpture, European mostly, 19th, 20th century, and archaic Chinese bronzes too. And I'm also involved as the chairman of MoMA. So that
Museum of Modern Art.
gets me involved in modern and contemporary.
So to somebody who's here saying, I'd like to be like you, building a successful company, and and very involved as you are in philanthropy, what would you say is the key to your success? Is it you worked harder than other people, you surrounded yourself with very good people, you just had a better eye for deals? What would you say is the key to building a successful private equity firm, and what would you say is the key to your success?
That's a tough question. As I already mentioned, I think luck has to do with it. I think getting on board when that Drexel rocket ship started going up was pretty lucky. I think how we started as Apollo with Credit Lyonnais was pretty lucky. But one of the best things was always mixing with smart people. And learning really how to direct them into a team effort towards a common goal. We're blessed with having a very deep bench at Apollo. I have great partners, and I think we have a defined brand. I think we have a defined direction. We've been very fortunate to have fabulous investors, limited partners, building those relations, building long-term relations.
Any regrets?
Well, there are loads of deals that it would have, could have, should have, but no, I consider myself pretty blessed.
All right. So the question that everybody gets asked in your business, and I get asked, if I have some extra money, should I buy the stock or should I put the money in the funds, your funds? Which should I do?
This is all on the record?
I assume you'll say both, but is there...
I would say all of the above.
Okay.
So.
Thank you very much. I think we're out of time. Thank you.
Thank you.